Let's begin Samsung SDS monthly webinar for February. Nice to meet you, everyone. I'm Amy Cha of Logistics Market Intelligence Group in Logistics Division at Samsung SDS. Starting this year, the Logistics MI Group will be hosting webinar every month. Let me briefly explain the background and purpose of this monthly webinar. The Logistics MI Group publishes global logistics trends based on its monthly reports and quarterly reports, which include economic, air, ocean industry, and regional trends. We appreciate your taking time to read our report despite your busy work schedule, and will continuously strive to provide high-quality information so that our reports can be useful in your daily business and decision-making process. Our monthly and quarterly reports will cover global logistics trends, including various market indicators. However, not everyone may find them easy to read and understand. Our monthly webinar aims to provide easy-to-understand and interesting interpretation on what each indicator means to assist your daily business and to further enhance Samsung SDS expertise and awareness in the logistics market. Then, let me introduce today's agenda and presenters.
Hello, I'm Sylvester Lim, and I'm in charge of Maritime Market Intelligence at Logistics MI Group. Though it's a bit late, I wish you all a happy new year and good health. Now, I'll begin the presentation on ocean market conditions and trends. First, let's look at the forecast for freight rates and the SCFI in the first quarter of 2024, as predicted by the Logistics Data Innovation Group at Samsung SDS. In January 2024, the average composite index recorded 2,130. However, from mid-February, as the effects of the Lunar New Year holiday dissipate, through March, traditionally a low season, we expect it to gradually stabilize. In March, the average is projected to decrease to 1,829. Let's examine these trends in detail through route-specific freight rates. As of February 2nd, the U.S. East Coast showed levels around $6,652 per FEU, which are anticipated to decrease to an average of $5,050 in March. The U.S. West Coast, recording $5,005, is expected to drop to an average of $3,580 in March. Meanwhile, the spot freight rate to Northern Europe, which was around $2,723 per TEU, is forecasted to decrease to around $1,550 in March. Now let's take a look at the market outlook from leading global institutions. Firstly, Drewry anticipates that the rerouting of shipments due to the Red Sea crisis will temporarily reduce effective vessel capacity within the market, leading to some improvement in the supply-demand balance for vessel capacity in 2024. However, despite this, they forecast that the annual imbalance in supply and demand will persist due to the significant surplus of supply. Meanwhile, the MSI, Maritime Strategies International, a global shipping consultancy, forecasts a container volume growth rate of around 4% for 2024, similar to Clarkson's projection of 3.8%. However, the forecasted supply growth rate is much higher at 7%. Therefore, 2024 is anticipated to be one of the years with the largest supply-demand imbalances in recent decades. Considering these forecasts, the recent upward trend in freight rates is deemed to be temporary, attributed to the Red Sea crisis. It is expected that once the situation resolves, the market will return to normalcy but may face challenges again. Perhaps an apt expression for this situation is Chunli Bulsachun, from a poet in the Tang dynasty, meaning spring has come but it's not the awaited spring. This is the latest data on global container fleet status presented by Clarkson's. The estimated annual newbuilding deliveries for 2024 are expected to surpass the record set last year, reaching 2.67 million TEUs, a significant increase from the 2.21 million TEUs in 2023, marking a new all-time high, although the number of vessels being scrapped has increased approximately threefold, from 160,000 TEUs in 2023 to 450,000 TEUs, it is insufficient to offset the growth in supply. Therefore, the fleet or the supply growth rate for 2024 is projected to remain at the same level as the previous year, standing at 8%. This is anticipated to result in a total vessel capacity of 30 million TEUs being supplied. Now let's examine the demand, specifically the fluctuations in containerized cargo volume. The graph you're currently viewing illustrates the demand and supply projections regarding containerized cargo volume, as presented by Clarkson's in the previous slide regarding container vessel fleet. In 2023, containerized cargo volume showed a slight rebound of 0.3% year-on-year, driven by improvements in demand dynamics, indicating a modest growth in just a year. In 2024, we anticipate a relatively significant demand growth of 3.8% compared to 2023, driven by the ongoing recovery in demand in North America and Europe since the fourth quarter of 2023. Additionally, expectations of interest rate cuts following the Fed's decision to hold rates steady in December have also contributed to this upward trend. However, it's important to note that this demand growth rate still significantly lags behind the supply growth rate of 8% projected earlier. Let's take a look at the SCFI Composite Index. Reflecting the disruptions in the Panama and Suez Canal supply networks, the average value for January surged by 73.2% month-on-month, reaching 2,130. Particularly noteworthy is that the figure surpassed the 2,000 mark for the first time in a year and 4 months since September 2022. Examining route-specific freight rates according to the SCFI released on February 2, freight rates for the U.S. West Coast have risen for 10 consecutive weeks, while those for the U.S. East Coast have increased for 8 consecutive weeks, reflecting the recent recovery in demand. However, the Europe route shows a different trend, due to a sluggish economic recovery compared to the North American market and competitions among carriers for securing cargo following the week-long Lunar New Year holiday from February 10th. There has been a 3-week consecutive decline, presenting a different picture compared to the North American route. Now let's examine the KCCI Composite Index, which is released by the Korea Ocean Business Corporation. It's worth noting that the KCCI index is based on freight information from 13 routes departing from Busan Port, providing a more tailored reflection of South Korea's container freight market conditions. Similar to the SCFI, the KCCI also saw a significant increase, recording an average of 2,217 in January, marking a surge of 66.8% month-on-month. This marks the first time the index has surpassed the 2,000 mark in 13 months since December 2022, indicating the recent supply chain crisis. Now let's delve into the trends of the global top 10 container shipping companies. The undisputed leader, MSC, currently has a total vessel capacity of 5.6 million TEUs, with a market share of 19.7%, marking a 0.2 percentage point increase compared to the previous month. Notably, when examining the ratio of remaining orders to total vessel capacity for each company, MSC stands at 26.2%, while the third-ranked CMA CGM is at 33.5%, indicating a high level of backlog. This observation suggests that, among the top 3 carriers, excluding Maersk, both MSC and CMA CGM are pursuing aggressive strategies to expand their fleet, while Maersk is focusing on its transition into a comprehensive logistics company. In January of this year, news emerged regarding new vessel orders from ONE, a member of the alliance, to which HMM belongs. It was reported that ONE ordered 12 methanol-fueled container ships with a capacity of 13,000 TEUs each. This order accounts for 8.7% of ONE's current vessel capacity of 1.8 million TEUs. This move can be viewed as part of their environmentally friendly propulsion strategy, in preparation for regulations such as the EU ETS. This is a comparison graph provided by Alphaliner, a French maritime research firm, showing the vessel capacity deployed on the east-west routes by alliances. Firstly, the vessel capacity deployed on the Asia-North America route stands at approximately 530,000 TEUs in January, showing a marginal decrease of 0.5% month-on-month. On the Asia-Europe route, the vessel capacity deployed reached around 440,000 TEUs in January, marking a 5.1% increase year-on-year. This increase can be attributed to several factors, including the baseline effect of the market downturn caused by the Russia-Ukraine conflict at the beginning of 2023, as well as the direct impact of the Suez Canal transit restrictions, which led to an increase in vessel deployment to reroute vessels around the Cape of Good Hope. This is the Schedule Reliability Index provided by Sea Intelligence, a Danish maritime research firm, for global major routes. The average schedule reliability of container shipping lines on 34 routes worldwide in December 2023 recorded a significant 5% points decrease, dropping from 61.8% in the previous month to 56.8%, falling below the 60% mark for the first time in 11 months. This can be attributed to the transit restrictions in the two major canals. Particularly noteworthy is the significant decline in schedule reliability on the Asia-North Europe route. In December 2023, amidst the escalation of the Houthi rebels' attack in the Red Sea region, the schedule reliability plummeted by 9.1 percentage points to 46.4% compared to the previous month's 55.5%. Let's look at the average delay days. The average delay days showed improvement trends from around 7.5 days during the pandemic period in 2021 to around 5 to 4 days until September 2023. However, from October to December, there has been a consecutive increase in the average delay days, reaching 4.9 days in October, 5.1 days in November, and 5.4 days in December, indicating a worsening trend over the past 3 months. Examining the schedule reliability for December 2023 of major shipping lines, Evergreen demonstrated the highest 64%, followed by CMA-CGM with 60%. Only these two liners achieved schedule reliability of over 60%, and all the other liners showed a deterioration in their schedule reliability compared to the previous month. Next is the current status of container equipment supply at major production hubs in the Asian region. These tables are updated by a network of major carriers and forwarders at Samsung SDS RHQs. Looking at the major ports in China, it appears that container equipment supply is limited for specifically Maersk and COSCO from the surveyed carriers. However, with the emergence of delays in the arrival schedules of backhaul vessels from Europe bypassing the Cape of Good Hope instead of the Suez Canal, it is becoming evident that the shortage of container equipment to intensify gradually. This situation is not only affecting China, but is likely to also impact major ports in Southeast Asia, such as Ho Chi Minh and Bangkok. Therefore, it will be important to monitor the equipment supply situation closely, especially as the situation in the Red Sea region continues to evolve for some time. Let's examine the current situation of container vessels waiting at major ports in North America. Of the 6 graphs, the top 3 represent the number of vessels waiting at each major port, while the bottom 3 represent the waiting days at each major port. Starting with the major ports on the U.S. East Coast, such as New York and New Jersey, despite supply chain issues such as congestion at the Panama Canal and the Suez Canal bypass except for a brief congestion in the second week of January, the number of vessels waiting in the outer port is around 2, with waiting days of approximately 0.3 days, indicating smooth operations. Moving to the U.S. West Coast ports of Los Angeles and Long Beach, despite the ongoing Chinese Lunar New Year holiday and the backlog of cargo from the U.S. East Coast, the number of vessels in the outer port is around 23, with waiting days of approximately 3.5 days, maintaining a stable level of operation. This is the current status of container throughput at global ports. The left table shows that the December 2023 throughput at the prominent port of Long Beach on the U.S. West Coast surged by 30.5% year-on-year. This increase can be attributed to the increase in cargo volume via the West Coast due to the transit restrictions in the two major canals. Hong Kong, once a prominent transshipment port in Asia, has yet to regain its previous status since its competitiveness weakened due to a sharp drop in transshipment volume due to port congestion during the pandemic. As of December 2023, the throughput has decreased by approximately 13% compared to the same period last year, indicating a further deterioration in its status. Here, we've selected key news from the ocean market for the month of January. We've chosen 3, but due to time constraints we'll only cover 2. First, let's discuss the container equipment shortage at ports in India, as reported on January 22. As mentioned earlier on the container supply status slide, there are concerns about a shortage of container equipment at major trade ports in India such as Nhava Sheva and Mundra. Originally, this region had a surplus of empty containers due to low matchback, which compares inbound containers to outbound ones. However, due to scheduled delays resulting from the Red Sea crisis, equipment supply has become difficult, leading some shippers to even consider giving up on bookings. Next, let's discuss an interesting article from January 24. It analyzed the increase in carbon dioxide emissions resulting from the Red Sea crisis. When considering the Asia-North Europe route, it was found that rerouting led to a 31% increase of carbon dioxide emissions due to the increase in sailing distance. Additionally, Increasing vessel speed to maintain weekly services resulted in a 14% increase in emissions per knot. Lastly, transitioning to smaller vessels with lower fuel efficiency for the purpose of increasing speed led to a staggering 141% increase in CO2 emissions. In summary, the current concerns in the supply chain are having a significant negative impact on the environment as well. Next is the analysis of key issues in the ocean market. One of the important agenda items for this webinar is the formation of the Maersk and Hapag-Lloyd Gemini cooperation. On January 17th, Maersk and Hapag-Lloyd announced plans to establish a joint operation named Gemini Cooperation. The commencement date is slated to be in February 2025 following the dissolution of Maersk's 2M alliance in January 2025, Hapag-Lloyd, after parting ways with the alliance, which it was part of since 2017, is also expected to join this new cooperation. Since the word Gemini means twins, the market predicts that there will be no additional members other than the two companies. The official collaboration period is said to be 3 years with an option for an additional year. The foundation of the Gemini cooperation is built upon the hub-and-spoke strategy, which has long existed in the market but has not been implemented by any carriers. This strategy involves minimizing port calls in main services by relying on 12 major hub ports and a robust global shuttle, also called feeder networks, to strengthen shipping networks connecting these hubs, thereby shortening and streamlining routes. The goal is to recover schedule reliability from the current 50 to 60% range to around 90%. Initially, it is expected that the 3 shipping companies of the alliance, which Hapag-Lloyd belongs to, ONE, Yangming, and HMM, will find it difficult to maintain competitiveness against Ocean Alliance, MSC, and Gemini after the departure of Hapag-Lloyd. The bar graph on the left shows each alliance's total deployed capacity for joint operation as of January 2024. As you can see, when Maersk and Hapag-Lloyd formed Gemini, the estimated total deployed capacity of each alliance, based on this graph, would rank as follows: Ocean, 4.28 million TEUs, Gemini, 3.4 million TEUs, MSC, around 3 million TEUs, and then the alliance, 2.3 million TEUs. In the case of MSC, when looking at the graph after the restructuring, the ship fleet appears to be smaller than that of the alliance, but MSC, which ranks first in overall ship fleet, will already be able to provide weekly service on its own by adding ships that were not previously deployed to the alliance, and this level exceeds the alliance's capacities. Ultimately, the 3 carriers in the alliance will have options such as attracting new partners from the Ocean Alliance, individually joining the Ocean Alliance, or enticing non-alliance carriers like ZIM or Wanhai from Taiwan. However, market consensus suggests that none of these options will be easy to pursue. Now, with Gemini set to commence within a year, the restructuring of ocean alliances adds another layer of volatility for market participants. It's a crucial moment that demands attention and preparation from all involved parties. The next main issue has been prepared under the title, Prolonged Red Sea Crisis. Logistics disruptions persist, particularly focusing on the Asia-Europe cargo utilizing the Suez Canal, stemming from the escalated crisis in the Red Sea region since December last year. Xeneta, a maritime aviation research firm in Norway, has reported that the Red Sea crisis poses a significant problem on the supply side rather than the demand side. Supporting this assertion, the graph on the left, published by Sea Intelligence, illustrates how specific events have impacted weekly capacity supply compared to the 52-week average baseline. Negative values indicate a shortage in weekly capacity supply, providing intuitive insights into the impact of these events. In March 2021, when the Ever Given, owned by Evergreen, ran aground in the Suez Canal, it marked the most severe shortage in supply, recording a figure of -87%. As you can see, the current weekly supply shortage due to the Red Sea crisis is at around -55%, which analysis suggests is even more impactful than the 2 waves of the pandemic where supply shortages were witnessed. Additionally, frequent route changes, delays, and call cancellations have exacerbated the shortage of containers. Xeneta has forecasted that considering these factors alongside the approach of the Chinese Lunar New Year, ocean freight rates are expected to rise further in early February. That's all for the portion I prepared regarding the February webinar on the ocean market. If you have any questions, Please feel free to ask through the channels provided, and I'll do my best to address them. Thank you for listening attentively for a long time, and please stay tuned for the upcoming segment on the trends in the air market by our colleague, Amy Cha. Thank you.
Welcome back. I am Amy Cha, in charge of Air Market Intelligence at Logistics MI Group. Let me address the current air market trends. This graph shows TAC index, which represents air market trends. Some of you may be familiar with this graph, but if you're not sure what this is actually about, please pay attention. TAC index is the freight rate index calculated by dividing the general costs incurred between origin and dest airports by actual weight on a weekly basis. In other words, it's a graph that shows the unit cost of air freight rate. Given that rate fluctuations are largely driven by demand and supply balance, it can be used to get a glimpse of air freight volume as well. Let's take a look at freight rates from China, Hong Kong, and Vietnam, countries with many manufacturing bases. To find out how the market is trending, Hong Kong, Europe. Airfares dropped from $5.35 in December 2023 to $4.12 in January 2024. Similarly, Hong Kong to U.S. fares recorded $5.02 in January, down from $6.85 the previous month. Shanghai to Europe rates decreased to $3.55 in January from $4.60 the previous month. Shanghai to U.S. rates reduced to $4.31 in January from $6.36 the previous month. Vietnam to Europe rates dropped to $3.92 in January from $4.25 the previous month. Vietnam to U.S. rates decreased to $4.91 in January from $6.81 the previous month. As you can see, air freight rates are declining on all routes compared to December 2023. This is largely due to consumer sentiment preparing for the year-end market, which has boosted e-commerce volumes in China since November 2023. The resulting increase in freight rates continued to December, but volumes tapered off in January, naturally leading to rate reductions. There's an interesting point in this graph. Contrary to the declining trends, the last indicator in January shows an upward trend, meaning the freight rates are going up. Let's look at the results again by destination. Europe routes are not experiencing as much of a drop as U.S. routes. How this attacks in November last year would have an impact on FMCG and fashion industry, with high inventory turnover rates in securing scheduled inventory in February and March. In addition, we believe that the increased volumes to reduce the inventory before the Lunar New Year have added to the upward pressure on freight rates. That is why February freight rates have started on an upward trend. Next is the TAC index forecast. Samsung SDS Logistics Data Innovation Group is forecasting the TAC index based on its system dynamics model. Since forecasting airfare unit price can be a high value point, we will have time to delve into this model in our next monthly webinar with Mr. Sungchul Hong of Logistics Data Innovation Group. The TAC index for Hong Kong to Europe routes is expected to be fairly flat at $3.9 to 4.2 in first quarter, $3.5 to 4.3 in second quarter, and $2.9 to 3.5 in third quarter 2024. The TAC index for Hong Kong to U.S. routes is forecasted at $4.7 to 5.2 in first quarter, $4.7 to 5.0 in second quarter, and $4.3 to 4.5 in third quarter 2024. Let's move on to the short-term outlook. Vietnam, which has a major export base, saw a 62% surge in volumes in the third week of January compared to the previous week. It was 6% higher than the last week of October, which saw the highest volumes last year. This spike in volumes was largely driven by a new mobile device launch made in Vietnam. China-Europe routes are also seeing an uptick. European manufacturers that rely on China for parts and raw materials are facing difficulties in supplying key components. In particular, the increasing number of ships bypassing the Cape of Good Hope has raised red flags for automobile production in Europe. Since January, global automakers with production facilities in Europe, such as Tesla and Volvo, have decided to shut down their production lines until February due to parts supply issue, and Stellantis, which produces Fiat and Peugeot, has been sourcing key parts to its European plants via air transportation since the Red Sea crisis. However, since this is only a short-term solution in terms of cost, many shippers are looking for various intermodal transportation modes. Many of them opt for sea and air products offering alternative routes via Dubai or LAX, with shorter transit time than ocean routes bypassing the Cape of Good Hope and cheaper prices prices than air transportation, as most freight volumes are concentrated in Dubai and LAX transshipment points. Freight rates are rising even at the beginning of the year. Looking at sea and air freight rates, it costs 52 cents per kilogram to ship by sea from China to Europe, but if you switch it to all air services, it costs $2.95 per kilogram, which incurs 6 times higher logistics costs. The compromise is transiting Dubai or LAX, with sea and air freight rates being $1.33 per kilogram via LAX and $1.61 per kilogram via Dubai, according to Zeneta. Next, let's look at the cargo supply. Let's see how cargo supply will change in 2024 compared to 2019. Why compare with 2019? While the post-COVID-19 era with new social standards is often called the new normal era, there is a high expectation that things will return to the pre-COVID-19 society in 2024, which will be known as the re-normal era. Therefore, a comparison with 2019 will be a good indicator of the logistics market. Cargo supply from December 11, 2023 to January 7, 2024, 4 weeks, was up 6% compared to the same period in 2019. The most noticeable change comes from Asia-Europe routes, which saw a big fall in supply to -17%, likely due to the ongoing Russia-Ukraine war. Cargo from Asia to North America increased by 21%, and cargo from Asia to Middle East increased by 30%, as international travel demand and e-commerce volumes gradually increased. It is also worth noting that the supply of passenger planes is higher than cargo planes. While still plus 21% higher than in 2019, the supply of cargo planes is expected to decline compared to 2 years ago, when the pandemic was at its peak, due to fewer urgent charter flights to transport diagnostic kits and vaccines. On the other hand, the supply of passenger planes is expected to increase, which will be further elaborated in the next slide. If you take a look at the passenger plane supply, you'll be able to understand what the re-normal era means. In 2024, the supply of international passenger planes has recovered to 98% of the same period in 2019 in weeks 1 to 4. In the 12th week, it is expected to match the 2019 level, but there will be some impact in supplying passenger planes to certain regions that are still at war. Let's take a look at cargo supply and demand as provided by IATA. We can see supply and demand through a metric called IATA monthly statistics. CTK, marked in green line, represents capacity or performance, which is the weight of cargo transported by air multiplied by the flight distance. On the other hand, ACTK, marked in blue line, represents supply, which is the weight that can be loaded on an airplane multiplied by the flight distance. CLF, marked in yellow shades, represents the load factor. The higher the load factor, the closer the gap between supply and demand. Global air freight demand continued to grow moderately through November 2023, but is still slightly below its 2019 year level. Conversely, supply increased by 3.3% compared to 2019. Next, let's take a look at Incheon Airport's cargo volume as reported by the Incheon International Airport Corporation. In December 2023, Incheon Airport's cargo volume reached 247,000 tons, the highest in 23 years. It was up 6.4% from last year, but still minus 2.3% compared to 2019. Nevertheless, export cargo volume to the U.S. increased by 19% compared to 2019 due to increased e-commerce volume from China. Next is about jet fuel and fuel surcharges. Jet fuel used in airplanes is different from diesel or gasoline used in cars. Jet fuel is refined to keep engines running in harsh environments with high altitudes and low temperatures. When the jet fuel is above a certain level per gallon, a fuel surcharge is added to the freight rate. Korean flag carriers charge fuel surcharges based on the Singapore Spot Market Price Index, and fuel surcharges are charged over short, medium, and long distances when the average jet fuel price of the previous month is above $1.40 per gallon. The jet fuel price has been reduced by 18% year-on-year. And on February 16th, Korean flag carriers announced that fuel surcharges will be KRW 710 per gallon. Finally, this section is about current market issues. Many shippers are still lukewarm about switching to the sea-air service, and major global forwarders are showing similar reactions. Kina plus Nagel is expecting a 25 to 30% increase in sea and air demand compared to the usual times, but says it's sufficiently affordable based on the experience during the pandemic. Geodis Wilson also has no plans to increase supply to meet increased demand and is noticing an increase in volumes from China to Europe and North America, but says its capacity is sufficient for now. In conclusion, today's webinar focused on concerns about whether the disruptions to the global supply chain would be repeated. While there has certainly been an impact on some industries, we do not believe there will be a long-term impact on the entire aviation industry. Shippers with time-sensitive cargo find the current container market conditions very challenging, and while some inventory is being urgently shifted to air services, most shippers are accepting the change in delivery schedules and considering sea and air modes transiting via LAX and Dubai, which offer more reasonable freight rates, rather than shifting to air transportation. This is the end of the presentation for air, and let's move on to today's summary. How did you find the presentation? To wrap up, I'll provide a summary of the key points discussed regarding ocean and air trends. Summarizing the key points in ocean trends, we can outline them with the keyword ongoing supply chain instability. The Red Sea crisis has led to a sharp increase in freight rates, and whether it will prolong will be a determining factor in the trajectory of rate hikes. Predictions foresee a challenging year ahead due to record-high supply surpluses. With the formation of Gemini, intense competition among carriers for alliance restructuring is anticipated. These are the keywords of the air market trends. Short-term rise. Airliner supply has gradually increased as travel demand recovers, and e-commerce volumes centering around apparel and consumer goods will continue to drive freight demands before and after the Lunar New Year holiday. Demand and supply have been increasing steadily, but supply chain risks remain as winter climate abnormalities have paralyzed some airports. Did you enjoy the webinar for February 2024? We hope today's material has been valuable for your decision-making process. In the past, there weren't as many variables caused by factors such as wars, diseases, or environmental issues. However, that's not the case anymore. That's why we need even more data, and Logistics MI Group strives to research and provide high-quality data to enable data-driven decision-making. We'll see you again in the March webinar, and if you have any questions during the webinar, please don't hesitate to reach out to Logistics MI Group. Thank you.